In this comprehensive analysis, we'll delve into the implications of the Federal Reserve's recent decision to pause rate hikes for the remainder of 2023, marking a significant shift in its monetary policy approach. The Fed's new stance is rooted in the belief that they have completed their cycle of raising interest rates, a move that has sparked various predictions about the future of financial markets, encompassing stocks, real estate, and the impact on savings accounts. If you appreciate the information on our video, go ahead and be generous, and don't forget to hit the like and subscribe button. Now, let's begin. In examining the Federal Reserve's recent policy updates, it's essential to recognize the broader economic context influencing these decisions. The slight decline in the overall inflation rate to 3.1% signals a positive trend towards the Fed's target of 2%. This reduction is more than a mere statistical change. It represents a potential turning point in the ongoing battle against high inflation, which has been a persistent concern for both policymakers and the public. This improvement in inflation metrics is a critical factor in the Fed's decision-making process regarding interest rates. Historically, high inflation has often led to aggressive rate hikes as a countermeasure. However, the current scenario suggests a more nuanced approach may be warranted. With inflation showing signs of easing, there's room for the Federal Reserve to adopt a more measured stance. This could mean slower or fewer rate increases, or even rate cuts should the trend continue. Such a strategy is vital to avoid unnecessary shocks to the economy, which could manifest in various forms, including skyrocketing consumer costs or a slowdown in economic growth. Moreover, the observed decline in inflation, though modest, injects a sense of optimism into the market. It alleviates some pressure on the Fed to keep tightening monetary policy, potentially leading to a more stable and predictable economic environment. This stability is crucial for long-term planning and investment, both for businesses and individual consumers. It also provides some relief to sectors that are particularly sensitive to interest rate changes, such as housing and automotive, where financing costs can significantly impact consumer demand. In summary, the Federal Reserve's navigation through the complexities of monetary policy amidst changing inflation dynamics is a delicate balancing act. The recent decrease in inflation, while slight, is a promising indicator. It not only suggests a move towards the Fed's desired inflation target, but also opens the door to a more balanced approach in monetary policy, crucial for sustaining economic growth and stability. Despite this positive trend, certain sectors like car insurance have witnessed a significant spike in prices, with a 19.2% year-over-year increase, the highest in nearly 5 decades. This surge is attributed to the rising costs of car repairs and replacements, prompting insurance companies to hike their premiums. The Federal Reserve, however, places more emphasis on the Core Consumer Price Index, CPI, which excludes volatile categories like food and energy. The core CPI has been relatively stable, with a notable increase in service-related costs like medical care, tuition, and utilities. Interestingly, the shelter component within the core CPI is showing signs of a slow decline. This is partly due to the nature of housing leases, which are often fixed for 1 to 2 years, thereby locking in rental prices. With national rents starting to decrease, this trend is expected to reflect in the core CPI by spring 2024. The dynamics of the housing market in 2023 have been intriguing, with a notable 5.5% increase in home prices as reported by the Federal Housing Finance Agency. This surge, encompassing regions with typically subdued market activity like Hawaii and the District of Columbia, can be largely attributed to the interplay of high mortgage rates and homeowner reluctance to sell. High mortgage rates have a twofold impact. They discourage potential buyers due to higher borrowing costs and simultaneously dissuade existing homeowners from listing their properties, as they may already have more favorable mortgage terms. This results in constrained market inventory, contributing to the upward pressure on home prices. As we look ahead to 2024, the forecast suggests a shift in this trend. Analysts, including those at Goldman Sachs, anticipate a moderation in the pace of home price appreciation. The projected 1.7% decrease in national home prices is a significant indicator of this change. This moderation aligns with the return to the long-term average appreciation rate of around 2%. This trend suggests a normalization of the market, moving away from the rapid price escalations witnessed in recent years. Regional variations are expected, with cities like Detroit and Rochester potentially seeing continued price rises, while markets like Austin and San Antonio may face price declines. These regional differences will be shaped by local economic factors, housing supply, and demographic shifts. Turning to the stock market, 2023 has witnessed remarkable gains across major indices like the S&P 500, Dow Jones, and Nasdaq. This bullish trend has been influenced by factors such as the 10-year Treasury yield, which acts as a barometer for mortgage rates and the broader cost of borrowing. The declining inflation and the Federal Reserve's indication of pausing rate hikes have fostered investor optimism, fueling these market gains. However, it's important to approach these trends with caution. Stock market valuations don't always reflect underlying economic conditions accurately. Factors such as investor sentiment, geopolitical events, and market speculation can drive prices in ways that may not align with economic fundamentals. Therefore, while the current market conditions seem favorable, investors should remain vigilant and consider the broader economic context in their decision-making processes. Both the housing and stock markets are at a pivotal point influenced by macroeconomic factors like mortgage rates, inflation, and Federal Reserve policies. As we move into 2024, the anticipated moderation in home price appreciation and the cautious optimism in the stock market represent a transition towards more stable and predictable market conditions. However, given the complexity and interconnectedness of these factors, continuous monitoring and analysis will be essential for understanding and navigating these markets effectively. The Federal Reserve's recent communications, particularly those from Chair Jerome Powell, reflect a strategic and measured approach to monetary policy adjustments. This cautious stance is rooted in the desire to achieve a soft landing for the U.S. economy, a scenario where the Fed successfully manages to cool inflation without triggering a significant downturn or recession. The anticipation of rate cuts as early as March 2024 highlights the market's optimism and expectation for a more accommodative monetary policy. However, Powell's emphasis on assessing the full impact of current policies before proceeding with further changes underscores the Fed's commitment to a data-driven and prudent approach. This cautious strategy is particularly pertinent given the complex economic environment. The U.S. economy is navigating a delicate balance between maintaining job market strength and controlling inflation. The labor market has remained robust, which is a positive sign of economic health. However, a strong labor market can also contribute to inflationary pressures, as higher wages can lead to increased consumer spending, potentially driving prices up. Thus, the Fed's policy decisions must carefully consider these interconnected dynamics. Furthermore, Powell's insights into the lagging effects of monetary policy highlight the Federal Reserve's understanding of the intricate nature of economic response mechanisms. The time it takes for interest rate adjustments to percolate through the economy is critical in shaping policy decisions. For example, a change in interest rates today might only affect consumer behavior or corporate investment strategies months down the line. Similarly, the impact on employment rates is often observed with a delay, as businesses gradually adjust to the new economic environment. This inherent delay in the economic response underscores the need for a measured and forward-looking approach in monetary policy. Acting too hastily could lead to overcorrection, causing unnecessary economic fluctuations and undermining the stability the Fed aims to maintain. Therefore, Powell's cautious stance serves as a buffer against potential economic volatility, ensuring that decisions are made with a comprehensive understanding of their future implications. In light of these considerations, the Federal Reserve strategy aims to avoid over-tightening, which could stifle economic growth, or being too lax, which could let inflation spiral out of control. This balancing act is crucial for sustainable economic growth. As such, the Fed's careful monitoring of economic indicators and measured policy adjustments are central to navigating the current economic landscape. The Federal Reserve, under Powell's guidance, is navigating a challenging economic environment with a focus on achieving a soft landing. The approach combines vigilance over inflation with a commitment to sustaining job market strength, highlighting the intricate task of monetary policy management in a dynamic and uncertain economic climate. In conclusion, while the Federal Reserve's pause on rate hikes signals a pivotal moment in monetary policy, the implications for inflation, the housing market, and the stock market are multifaceted and require careful consideration. As 2024 unfolds, these dynamics will play a crucial role in shaping the economic landscape, highlighting the importance of staying informed and adaptable in a constantly evolving financial environment. With that being said, if you haven't done so already, hit the like and subscribe button. By all means, leave a comment and I will respond. And turn on your notification bell so you don't miss out on any of our videos. This will help us grow our channel. Thank you so much for watching, and until next time!